Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Alphabet, also known as Google stock. But before we get into that, make sure to subscribe to the channel since I do individual stock analysis videos for many years. Took a little break and I've been getting back into it. I've done some recent videos reviewing my past analysis and given some updates. And make sure to subscribe to the channel and like the video if you want to learn more about the financials of these companies to find out if they're good values or potentially value traps, because that's what I do. So let's dive into Google stock here. So Google stock, as it's a very well-known company, everyone obviously knows about it, and it has recently ridden a lot of the AI hype. Back here, when it was about $150, everyone thought that AI was going to kill their business, but then they realized, well, it's an AI company, and now it is up to $332. So the question is this actually a good value here? Is this a good buy, or is this potentially a value trap? As we can see in our Guru Focus value band here, it is showing it is at the higher end, and this could be some potential overvaluation. It also currently has a PE of 30.78 and a forward of 29, implying there is not going to be much EPS growth going forward in the future. And a very, very low dividend yield. They started paying out just a very tiny dividend in the last few years here of 0.26%. So let's dive into the financials. So you can see the 10-year growth trend for revenue has been 20%, which is very, very strong, especially for a company their size. Also, which I don't go over in every stock, but I think is important for Google, is they have historically had a very good return on invested capital, and that's much higher than their weighted average cost of capital. So typically, when they do spend money, they are getting good returns on it. Although being under 30% is lower than what they have been way in the past at over 40%, and I may have some thoughts of where that is going in the future. So we can see in their last fiscal year here, they did a little bit over $400 billion of revenue, which was about a 15% increase from the previous year, which still is pretty big, but that's not at that 20% they did do historically over the last 10 years. So growth, well, still quite fast. 15% is very good. It is slowing a little bit. We can see the gross margins have actually increased a little bit in the last years, which is nice to see. And their operating margin right now is at 32%, which if we look at the past here is a little bit on the upper trend of things. So right now they are, at least from the income statement, they are making a lot of money and showing a lot of profits, but we're going to be elaborating a little bit about this a little bit later as we get into the cash flow statement. And an interesting thing with Google here is before they did not have virtually any debt since they really don't actually have to, but they have had more of an interest expense occurring in the current years here, although this is largely offset by the high interest income. But this is just because the interest rates right now are very high, and if interest rates do go down, you really shouldn't expect them to get this interest income in the future. But the amount it is compared to their overall income is quite minimal. So everyone has seen the recent big net income they have with this 32.8% net margin. But I think this is a little bit sometimes misunderstood, and people miss this other income that happened, which is really from the markup of some of their other investments, and they did not actually receive this cash. So if we actually were to exclude this other income, this kind of the ballpark amount from their net income here, they actually wouldn't be sitting at a 32.8% net margin, but be more about a 26% net margin. And you can see in the history here, they've been, this was maybe a little bit of a one-off here, but they're usually have been in the low 20s, mid 20s, and in reality, they're at about probably right now 26, which is a little bit more realistic. Although the EPS has been growing nicely, and well, Google does give the impression that they do buy back a lot of shares. This is, as we'll show in the cash flow statement, largely due to stock-based compensation because, well, they are buying back shares. They got 12,230 million. You can see the trend here, and it's really not increasing at a rapid rate. Well, there was a little increase before, but if we look back to 2010, this is now 15 years, they've hardly budgeted a share count at all. So, well, they're buying back shares because there's so much employee compensation, stock-based compensation. They're really just offsetting that and a little more, though this did increase and has been a little bit more aggressive, but I still think the amount of share buybacks they do and how they're actually returning capital to shareholders is quite minimal. And as we did see on the previous page there, they pay a very small dividend, and the share count isn't decreasing very much. So if you actually look at the end of the day, Google is taking all their money and just reinvesting it to grow the business and not returning anything practically to shareholders. So we look on their balance sheet. They do have a very high amount of total current assets of $206 million, which is largely in cash and cash equivalents, which is why they have that high interest expense. This has gone down a little bit from December 2020, the year ending December 2021. So they have been using that a little bit of this money for their basically AI infrastructure build out. And if we look at their current liabilities, it's sitting at only 102 million. So this is a very good current ratio. They have, basically still are sitting on tons of excess cash. Their total assets are at $595 billion, and that basically gives them 389 of long-term assets, which we are going to take out the goodwill, which is about 33 billion there. So they do have about $350 billion ish on the books, mainly in plant, property, and equipment. But this stuff does get depreciated over time, which we will be talking about. And in their basically liabilities here, the one thing that has changed is historically their long-term debt was obviously very, very low, but you can see recently it has picked up. And this is kind of interesting because even though they have all this cash on their balance sheet here, they have chosen to take some additional debt to use that instead. So it makes their cash look like it's still quite strong, hasn't increased that much, but that's because they, to fund a lot of this AI infrastructure build out, they have taken long-term debt to do so. So they are sitting, very good in the total stockholder equity, $415 billion, even if we take out that 33 billion of goodwill, they're still sitting at a very healthy amount, although as we'll get into the depreciation, it might be actually a little bit lower because as we get into the cash flow statement here, these are the two lines I want you to look at is basically the cash flow from depreciation here. This is how much they're actually depreciating on their income statement each year. And because it's been spent in the past, it gets added back in on the cash flow statement. So in the last year here, they only depreciated $21 billion. But if we scroll down a few lines here and we look at the purchase of plant, property, and equipment, the amount they spent on new infrastructure and new capital assets is $91 billion, which this is over 4 times as much. And well, it is normal for companies that are growing to invest more to grow the company, since that's how you basically grow a company. You can see in the past, if we back up to previous years, say 10 years ago, well, they had cash flow from depreciation was just under 4 billion here, and the amount they purchased was maybe about twice as much. Same thing for 2014. Ballpark, it was only twice as much. 2015 was that same case. This is a little less than twice as much, about twice as much. You can see kind of the trend is they've always been purchasing more plant, property, and equipment than their depreciation. And if you do kind of line these up for these past years, there's I think around a 5 to 7 year delay to when it catches up based on the exact depreciation schedule. And I think everyone knows they're doing a lot of AI build out, a lot of semiconductors, and people may have seen Michael Burry's overall analysis on everything with AI kind of saying that, well, even though the depreciation schedule, I think on a lot of this equipment is maybe 4 years, which actually might shorten this cycle of when they reflect it in the cash flow from depreciation here, the realistic life cycle may actually be even shorter. So the amount we're seeing on their balance sheet there, could potentially be a little bit overstated if they really aren't depreciating at the useful life of it and just on the standard depreciation schedule, which is just something you have to understand about how the accounting works. So as you can see, even 2019, 2020, 2021, again, the amount of purchase of plant, property, and equipment was only 2 times what the depreciation was. Then things start changing a little bit in 2022, and this is kind of when the AI stuff starts more coming into the picture and they start spending the money around that. Which I'm not saying it's a bad thing, just gets into the valuation, how we have to look at the company to create a reasonable value for it. And you see here, it's like, okay, a little bit under 14 billion in depreciation, but they spent over $31 billion. Here, less than 12 billion in depreciation, $32 billion spent. And then 2024, year end in 2024, they're only depreciating 15 billion. This is over 3 times as much at 52 billion. Now they're at 91 billion. So you can see that, well, the income statement looks really, really strong. And compared to the historical trends, it was, you could, yeah, say it's, oh, he's a little bit overstated because they're only spending twice as much. This ratio is really, really getting out of whack here. So if we were to take that, okay, say normally compared to the historical trends, they would have only depreciated, 40 billion dollars, or they would have only had new purchases of $40 billion. They've spent an additional $50 billion. So if we scroll back into the income statement here, and let's kind of take that, because there's 132 billion. This is not going to be a reoccurring thing. So we have 50 billion come off, and we have this, say, about 25 billion come off. That is over half their net income that we can kind of write off looking at in this manner. So the 30 PE in reality actually starts looking a lot higher, and their EPS is potentially looking a little bit inflated when we start looking at this lens, in my opinion. So let's get back into the cash flow statement here. The other big thing I was saying is there's a lot of stock-based compensation. As you can see, there's $25 billion of stock-based compensation. The repurchases have actually started going down a little bit in the recent years, and it's only $45 billion. So the amount they're actually repurchasing for stock now is only $20 billion. And the fact is they were purchasing a lot more before. I think the reason they've cut back more on the repurchases of stock is they're putting a lot into this AI build out. And the real question is, really how much is that going to be worth it, and how much is that going to drive their profit at the end of the day? Because when you actually look at Google's revenue breakdown here, they still make well over 80% of their money effectively just from their ads, which, well, yeah, sure, they apply a little bit of AI into it and this and that. Their actual AI services, which they're selling, which are growing, are kind of in the Google Cloud here, which this did grow 15 billion, and they did grow a little bit over 50 billion, but this really only accounts for around 4% of their growth. And at the end of the day, the real driver for Google is still the ads. And one thing I will say is that the ads, like, I have an e-commerce business myself, and what advertisers are going to spend, that's how much they're going to be able to basically make on their Google ads. And that's something they really don't have control over, and will go over a little bit through the affected by the economic cycles. And if we go to the chart here, the majority of Google's runs since they've really started becoming a sort of like ad search company, like way back here, they have not experienced a recession before. So we don't actually know what Google's ads are going to be like in a recession. And I'll give a little bit of my own anecdotal evidence. As I've maybe mentioned before a few times, and I have a few, based on like the inverted yield curve and some other factors, I kind of do think we actually could enter a real recession. Is it going to be like 2008, 2009? No, I'm not saying that, but there, could be a recession. And I spent a lot of money on Google Ads for my business myself, and I noticed basically a softening in the amount of conversions I'm getting. What Google does is they have switched mostly from things, this is how much I'm going to pay per click, to this is how much I want to pay for an acquisition. And I noticed last year, in the last basically half of last year, is that my cost per the acquisition basically was starting to rise, which is, I think, general consumer softening, and then other competitors are willing to try to bid more to get those smaller and smaller amounts of sales. And then, well, that wasn't great. A little bit kind of drop in the conversions there, a little bit more expensive in the last year. It wasn't too bad, but then when this whole Iran war started, conflict war, whatever you want to call it, in March, suddenly my sales and my Google conversions literally just dropped off a cliff. I don't want to give too many details about my business, but a little bit higher ticket consumer items, around $1,200 average, and I've never experienced just like a complete like flattening in sales of that. From February to March, there was like over a 30% drop for me in sales out of the blue, which I've never experienced before. And my Google ad spend was cut in half. And it wasn't that I actually cut it down, it's because Google could not provide me any acquisitions at the price I was willing to pay the previous month. So if this does reflect into other businesses or the over economic trends in other sectors, you could see how quickly Google's ad revenue potentially could be affected. So let's go back here and we're going to pop into the interactive chart. And the revenue with estimate here, they are going to continue to grow. I think that, this isn't obviously applying in for any recessions, but even with AI, that is going to grow at a rapid rate. Is it really going to be able to outpace the amount they are spending on CapEx? I personally think from the numbers we looked at, it's going to be very hard in the short term to get any positive returns when effectively, as we previously looked, they probably, the amount they spent for the AI stuff could have been like $60 billion. And the Google Cloud grew $15 billion in revenue, not look even at profits, just revenue. So right now they're spending way more than they're going to make in any short-term perspective, probably over the next few years. And the rate here is, it looks like it's going to grow under that 15% rate going forward. Let's see what the EPS with estimates are. And, it's in about that, same ballpark there of maybe 15% or a little bit lower. So one of the things I like to do, which I actually find works very well for, a company like Google, who I think will continue growing in the future. I just think that their profits are potentially going to get smacked, is looking at the relative valuations. And for example, the price to sales ratio, because of all the previous things I explained that can affect their net margins and therefore their PE, I think the price to sales ratio is a really good way to look at it and, to find the valuation there. And historically, as you can see, we've seen when the Google stock price was really high, the price to sales ratio was really high, and that not fare well going forward for the investment. Even in 2014 here, yeah, it was high, not even as high as it was today. And when that occurred, there was several years of slightly down to sideways action, and same thing here. So right now we're sitting at a very historically high price to sales ratio. And with what I was saying, I think the depreciation schedule is going to start catching up to them in the years. And when you don't have those one-time gains happening that really aren't actually cash, which I actually didn't show you, I should probably go into that and we can just tell from the financials actually that it was just being marked up and not actually in the cash there. As you can see, there we go, cash flow from others, negative 22 billion. So that $26 billion of income that we basically saw right here wasn't actually cash in their pocket. They were just realizing, at least on their income statement, profits from, bets they have, investments they have, but they haven't realized any actual cash from it. They haven't, sold it. That's just what the value is. So when we factor in that, we factor in that the amount of basically cash flow from depreciation, this is going to be rising a lot in the future, meaning there's going to be a lot more expenses on their balance sheet. It's going to really crunch their margins down to probably a more realistic level. So it's a very good chance that the net margins here, well, 32, it actually is probably 26. But with depreciation stuff, this could actually go back into the low 20s or potentially even lower, depending actually how much revenue and earnings are driven by the Google Cloud once they have to start depreciating this. So that actually could mean that we don't see Google significantly growing their EPS or growing their EPS at all in the coming years, because another factor we said is that they really aren't doing the amount of share buybacks. They're doing a little bit over the replacement because they're putting all the money into the CapEx spend for the AI. So overall, you can see my technical analysis, channel here. This is the trend that's going. It's pretty parallel with the moving averages. It's already bounced off the top here, which was, created from there. It's, a pretty good trend. It's rejected there. And, kind of at bare minimum, I'm still actually kind of probably long-term bullish on Google, but, I think there's a good chance things over the next year plus come down here. And that's a fair bit of downside. And that's personally why I've sold the stock recently, because I think it very clearly is a very high valuation. There's a lot of hype that's even baked into it to create this kind of record high price to sales ratio. And it's likely going to come, there's a good chance it comes back in this consolidation zone. And that's personally when I would be interested in getting in Google again, because again, if we look at the interactive chart, pop up my price to sales ratio here. If you actually bought during the dips here, when the price to sales ratio gets low, these were all very good times to buy Google from a short and a long-term perspective. So anyways, I hope you like the insights on Google there. Right now, I do think it is a little bit of a value trap, as all the accounting I went over and everything, and I do not see them being able to significantly grow their profits in the very short term. So I hope you like that analysis. You can give me your thoughts in the comments below, and make sure to subscribe to my channel and like the video. And I will see you in the next stock analysis.